We recently did an episode that talked about the battle of the financial industry jargon giants, QCD versus DAF. And a viewer had a question as we talked about qualified charitable distributions and donor advised funds and said, wait a minute, qualified charitable distributions, that's the required minimum distribution, right? Like, what's the difference exactly between those things? Because it all comes from IRAs. That's a great question. We love your questions. And on this episode of Friends Talk Financial Planning, we're going to explain exactly how those things are related, but why they're different. And then also talk about one sort of hidden trick in the Secure Act that can help people who maybe don't need to take minimum distributions save money on their taxes when they give to charity. So, hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Ramon. I've got a family financial planning practice in Chicago, Illinois. And before we get into RMDs and QCDs, please subscribe so it helps more people find our channel. So, John, what do you got to say? Let's start it out.
Yeah, I mean, first of all, just say we love it when we hear from people and go, listen, I was looking at this and going, I've got a question. That's the type of stuff that's really engaging for us to be able to help answer. And I love this question as you and I, we're talking, Bridget, before we hit record here. It's like we deal with this stuff all the time. We understand, you get into this jargony things. You go like, wait a minute, what is the difference between these two things? I know they're tied to an IRA and it happens, it applies when you're in your 70s, but what's going on here? So let's break down, if it's okay with you. Let's just start with what is the required minimum distribution from your IRA, or the RMD, right? We get into some of these acronyms with things. So the required minimum distribution is quite literally what it sounds like. It is the minimum amount that the IRS requires you to distribute from your IRA once you reach a certain age. So what happens is it used to be age 70 and a half, and then the first Secure Act changed it to 72, and now it's 73. It's actually going to go up to 75. But when you hit that age, you have to take out a certain amount of money from your IRA. And the sort of deal is, listen, the money went in all pre-tax. The IRS wants their money at some point in time, right? And what happens with that is it starts like around, there's a formula like 126.5 of the balance, it's like 4% or so when you're in your early 70s, and it grows by the time you're 90. I think it's around 8% of the value. And so you think about if you got $1 million IRA, here's an example, somebody who's not spending any money from their portfolio. Maybe I've got pension, maybe I got other things going on, real estate income, something, and I don't need the money from my IRA. I got $1 million. The IRS says, hey, once I'm 72, 73, I need to take out $40,000 or so a year and pay taxes on it. That is the minimum distribution. If somebody's spending money, right, I don't have pension or other income, I need my IRA to live on. Maybe I'm taking out 50 or 60 or $80,000 a year from my IRA. Great. The IRS says I have to take out 40. I can take out as much as I want to, but in that scenario where, geez, I don't really need the money, they sort of make us take that money out, right? Like that's the deal. And when the money comes out, then it's taxable to us. It's like regular income. So that's sort of the core of this required minimum distribution is, hey, once you get to be in your early 70s, you got to take money out, at least this much money out. And if you don't, then there's some penalties with it. So that's what the RMD is.
Yeah.
Right? I don't know if you had anything to add to that.
A couple of points. One, you can take money out of your IRA after 59 and a half.
Yeah.
So but you're just required at age 73 if you were born before 1960, and now they moved it up to 75 if you're born after 1960, and it's January 1st of 1960. So it makes it easier. I appreciated that.
Yeah.
So that's the cutoff point. And again, that is a relatively new law that just got passed at the beginning of the year, upping the ages. So, and then you're just required to take some money out. So
yeah, right. It's just, and it's like and these things are confusing. I tell you what, it's not like, all these things, but it is literally, if you think about it, right, as you're kind of, it's unlike, we were joking before, I go to the doctor and their blood pressure and I know the numbers, but systolic and diastolic and what is it like, that doesn't mean anything, but literally required minimum distribution. If you stop for a second and think about, oh yeah, that's the minimum amount I'm required to distribute when I get that age, it really tells a story. Maybe what about the qualified charitable distribution, the QCD?
Yeah, so the qualified charitable distribution. All right, so this kicks in at age 70 and a half. So once you're 70 and a half, if you want to take up to $100,000, most people do $100,000 and donate it directly to a charity, you can, and you bypass the tax, which
Right.
everybody.
And donate it directly to a charity from your IRA, right? That's what we're talking about. Look, I take IRA money, send it right to charity. Do not hit taxes in any fashion. All pre-tax money going to charity, right?
Exactly. So this is a great way if you're over 70 and a half to donate money to charity. It's a very tax efficient way to do it if you've got money in your IRA. So it's a great way to do it once you're 70 and a half. What you like to use is and you can get a checkbook. We've detailed this in other episodes. You generally get a checkbook from your custodian. So we work with Schwab, they'll provide you a checkbook. If you lose your checkbook, you can get another checkbook. And you can just give them write a check directly to a qualified charity. So it does take a bit for them to clear. And again, we've had episodes that detail it. But in this episode, we really want to talk about how they interact. Like,
Yeah,
so
that's
how do those interact?
well, you know,
So
it's funny. I'm sitting here thinking about, okay, we were and like the required minimum distribution. Like, okay, think about those words. Yep, that explains it. And you just described the qualified charitable. Okay, I'm gonna qualify a distribution from my IRA to a qualified charity, right? And you go like, okay, that's the thing. So these are two separate things. What's confusing about that? And here's where the connection is, right? Is that when you give money to a charity using a qualified charitable distribution that can satisfy the requirement to take a distribution from the IRA, right? So all distributions from IRAs are going to be taxable in general, right? 90% of the time. This is the one exception where if I write that to charity, that counts toward that minimum distribution. And when I do other things, I do a Roth conversion, that I pay taxes on that, but that does not count towards the required minimum distribution. When I do other things, but it's just this qualified charitable distribution can satisfy that need, right? So that's where it's two separate things, but they're connected in that fashion. I think that's the best way I know how to explain it. Does that make
yeah,
sense?
it makes sense. So the person you used that example before, the person that had a nice $1 million nest egg in their IRA, and then they had to. So when they're 70 and a half, they can start saying, "Hey, this is maybe I'm not itemizing, or maybe I just want to give money to charity, and maybe they get credit for it." I think people like getting credit for it on chances. They're giving money to charity. So all right, so I want to get some credit for this. So I'm 70 and a half. I don't have to take any money out of my IRA yet, but I'm going to start writing. I'm going to get a checkbook and I'm going to start writing my checks to my qualified charities from my IRA. Then you're going on to do, and you reach 73. Okay, now at 73, and this person, let's say they say I'm going to give $10,000 a year out of my IRA. Okay, they reach 73, and like you said,
And when you say $10,000, I want to be clear. I'm not taking that to spend. My goal in this scenario is I want to give $10,000 to charity every year, right?
sure,
Is that what you're saying?
exactly,
Yeah.
exactly. So it's going to the qualified charity with the checkbook provided by the custodian. Okay, so then you reach 73. Okay, so now I've got to take required minimum distributions. I find out generally from your custodian, or you can calculate yourself, how much you need to pay in your required minimum distribution. But let's say it's about $40,000. Okay, so I'm going to pay 40, but I still want to give away 10. So then all I have to do is take out 30 as a required minimum distribution, and I can give away the 10, and that counts.
Yeah, yeah. Let me just pull it out a little bit. I love that scenario, and this I've got a client situation I'm thinking about that's exactly in the spot. Something along the lines of, "Hey, I need to take out 40 because it's required for my minimum distribution. I don't need the money necessarily to live off of, right? But I want to give $10,000 to my church or to United Way or wherever, okay? So I write a check from the IRA to church and to charity, to United Way, and I give $10,000 away. I need to give out 40. I've given away 10 from that. Now I need to take out the other 30, put it in my pocket, put it in my investment account, let's say, and pay taxes on that. That satisfies the minimum distribution of 40, and 10 of it's gone to charity, right?
Exactly. That's exactly explained, right? So the other person could say, you know what, I want to give the whole 40 away. fair enough. Write the checks to charity, and then it won't even show up. Wait, you know what? It'll show up on your tax return also in one box, and then it'll have a little QCD typed in that you probably would miss. I mean, I see it, but, and then the taxable amount will be zero.
Yep. Yep. And that's, we have a lot of folks that do that too. And maybe they're RMD, the required minimum district, isn't quite as high as 40, but they say, listen, I have to take some of this money out of an IRA. Golly, I don't need the money. I could save it, I could pay taxes and save it, but why don't we just, take that minimum distribution amount that we need and use the qualified charitable distribution, give it all to charity. Because, and in that case, for our clients anyway, I don't have a goal. I don't want to give 10,000 or 5,000 or 15,000. But when it comes up, you go, listen, I have to take this out. Why don't we wipe out the taxes and just give it to charity? We'll figure it out each year, right? That's a very legitimate, and that's where those two numbers can be the same then, right? My RMD, my minimum required distribution, and my qualified charitable distribution might be the same thing. They aren't in fact the same thing, but the numbers might be the same, right?
Right. So
Let me throw one other scenario out at you. I love this idea of what are real examples on these things. What about, so I love all right, I need to take out $40,000 from my IRA, but I'm a little bit more charitably inclined. I usually give $50,000 a year to charity or $60,000 a year to charity. How can I be efficient with that?
you go just write all the checks from your IRA. As long as that works for you, totally, your overall financial picture, yeah, you use your IRA, you can give up to at least $100,000. And if you're getting to that edge, I think they changed it in the Secure Act so that it's going to be inflation adjusted. So it'll start edging up a little bit higher. So you can give, I know it's at least $100,000, maybe a little bit more. And that's just fine. So if you want, you have to take 50, or you have to take 40, but you want to give 50, you can write it all out of that up to 100,000.
And then again, that satisfies, right? So we put the goal first. What do I want to do? Do I want to give money to charity? Yes or no? This is not, well, I want to give 50. All right, great. I give 50. I do it from the IRA using the qualified charitable distribution because, like we talked about in the previous episode, that's a smart way to do it. And then separately, I can go, okay, how much do I have to take out? Oh, I only have to take out 40. I'm above that already. I'm good on that qualification, right?
Right, exactly.
Yeah.
So that's a great way to wrap it, or a good place to wrap it up, John. So I'm Bridget Sullivan Vermont. I've got a family financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. And both Bridget and I are taking on new clients. So if you're interested in these things, please reach out. We'd love to talk to you. But we're also both members of the Alliance of Comprehensive Planners, which is a group of nationwide fee-only tax-focused financial advisors who think similarly to how we think. So if you like what you hear on our show and you want to find an advisor local to your area, you can check out acplanners.org.
And please subscribe.